Hi, Robert Maltbie with Maltbie's Minute on the Market, pre-Thanksgiving edition. We're in the midst of a transition, I believe, to the second leg up of this secular bull market. We've been through a heck of a correction, particularly in the leadership in AI, ranging anywhere from 10 to 30, 40%, depending on the stocks you are in. So let's get into it right now. We are happy to bring out that our latest market momentum indicator is flashing some rather bullish signs. It's showing a meaningful improvement in market breadth and earnings expectations. We're seeing earnings growth above trend. That growth is broadening beyond the Magnificent Seven into industrials, healthcare, and financials. Very important. In fact, we see a 12-month upside potential of 8,000 on the S&P 500. That's over 17% upside from today's levels. The shift in earnings is important to look at. Earlier this year, we've seen the S&P earnings estimates at about 5% for the 493 x the Magnificent Seven. That has risen to 11%. Led by the industrial sector, real estate, infrastructure, energy, and technology, and what we call the second derivative AI beneficiaries. We had some interesting volatility to the downside, led by some weird conniptions in Fed funds. So I want to bring that out. We saw something fascinating. The Fed funds futures shifted dramatically, implying a material greater probability of an increase and then a cut. And honestly, it doesn't take much. These contracts are thinly traded. It's surprisingly easy to move markets with very little capital. A few $1 million can distort the signal substantially. So while the market interpreted a rate cut forecast, eventually we cautioned that it's a function of market microstructure, not just macro fundamentals. But this is confirmed and corroborated by tepid retail sales, weak job growth, and low PPI below expectations. So the near-term argument for a rate relief is strong. In fact, the market's pricing in not only normalization, but outright easing to come. Another controversial soundbite that rocked the markets last week is the AI and the front-loaded growth and high debt being issued. There's literally this is the most misunderstood dynamic going on. The arms race for AI dominance is not unlike the nuclear race in the 50s, where the US, China, Europe, everyone that knows that whoever wins the AI race leads the global economy. It's a world dominance variable. To build AI infrastructure, you need massive upfront capital. It's a front-loaded investment, so companies are issuing debt, and there's a counterintuitive part. The Magnificent Seven collectively produce nearly $1 trillion in EBITDA. That more than covers the interest rate on all the debt by over sixfold. That's historically benign and very sustainable. Let's look at the second derivative companies. You've got companies that supply the picks, the shovels, power management, fiber deployment, semiconductor tooling, robotics, cooling. These firms may have temporary capital constraints, but their growth curves are extremely steep with multi-year compounding built in. So here's the thesis for the bullishness. The infrastructure-linked AI exposure is end user. Attractive value entry valuations relative to the long-term total addressable market, strong management execution. Companies are positioning for multi-year revenue acceleration with a critical path towards suppliers rather than the commodity vector. Now, where does our Argonaut fund fit in? We've been able to consistently identify underfollowed and high alpha opportunities, not just the consensus trades. We've ranked in the top 5% over the last 7 years. We believe we're positioned exceptionally well for the broadening out of the bull market as leadership expands beyond the mega cap tech into smaller, high growth, and infrastructure sensitive sectors. So we're in a pivotal phase. Earnings growth is accelerating. There's broader participation, softening macro conditions, rate cut supportive data, massive long-term AI investment optimism, sustainable debt coverage, and a U.S. global push for AI supremacy. That sets the stage for material upside over the next 12 months. And we believe the S&P reaching 8,000 is not a stretch. It's a logical extension of earnings, momentum, and macro conditions. Investors should be prepared, not for the end of the bull, but for its expansion. Now let's focus in on our small cap stock idea of the month. It's a company called Mistras, ticker symbol MG. This is a leading provider of technology-enabled asset protection solutions aimed at safeguarding critical energy infrastructure and public infrastructure. They have beaten earnings and they've raised their guidance significantly through real growth and through cost cutting, a two-edged sword. We've taken our earnings estimates up significantly this year from 64 to 84 cents a share, and then next year up to 99 cents, nearly $1 and that per share. And $11-12, this stock, ticker symbol MG, is positioned for a move up to 17 in the next 12 months, providing a 50% return. So that's it. I want to urge you to visit our website, singularresearch.com. Sign up for a complimentary trial and get in front of our flow, our stream of high return, unique alpha generating small cap ideas and mid cap ideas. I'm Robert Maltbie, wishing you a happy Thanksgiving.